Welcome to the Financial Edge. I'm your host, and today we're talking about something that I think every single person who has ever put money into a market has struggled with. And I mean struggled. You can have the best charts, the most solid technical analysis, a robust strategy, and you still end up losing money. It is the most frustrating feeling in the world. Why does this keep happening?
Well, first off, if you feel that way, you are definitely not alone. It's almost a rite of passage. The data is pretty sobering, actually. Studies consistently indicate that somewhere between 70 and 90% of all retail traders lose money.
70 to 90%. That's staggering. So, is everyone just bad at analysis?
That's the fascinating part. No, a significant portion of those losses doesn't stem from a lack of technical knowledge at all. It's not that they couldn't read the chart. It's that their emotions got in the way. And this is precisely where this idea of psychotrading, or what most people just call trading psychology, comes into play.
Psychotrading. Okay, so unpack that for me. This isn't about candlesticks or indicators.
Not at all. This discipline goes far beyond that. Think of it as the art and science of managing your own internal state while you're operating. It's about preventing those huge, powerful emotions like fear or greed or that rush of euphoria from completely sabotaging your financial decisions.
I like the analogy you used when we were chatting before the show about the ocean.
Exactly. Imagine the market is this vast, unpredictable ocean. It's full of giant waves, that's the volatility, and those waves can easily sink your ship. Now, you might have the best map in the world. That's your fundamental and technical analysis. But if you don't have a firm rudder, which is your mind, you're lost. Without a disciplined captain, which is your psycho-trading, the moment a big wave hits, you'll either panic or get euphoric, and you will inevitably shipwreck.
A disciplined captain. I love that. I feel like most of us are panicked captains just spinning the wheel.
Most of us start that way.
So that's our goal for today. We are going to define what psychotrading actually is and what its function is. I want to talk about those specific dangerous emotions that we all face every day. And most importantly, at the end, I want to get into practical strategies. How do we actually master our minds before we try to master the market?
That's the key. And by the end of this, the goal is for everyone listening to have a powerful new mental tool, something that can genuinely improve their performance as an investor.
Fantastic. So let's start with that core definition. What exactly is psychotrading?
At its core, psychotrading, or trading psychology, involves the conscious control of emotions and thoughts when you invest. It's a simple definition, but incredibly hard to do.
Conscious control.
Right. It's founded on this core idea that markets don't move just because of economic factors or technical patterns. They are driven by the collective and individual psychology of all the participants. The market is people. It's a giant churning mass of fear and greed.
So what you're saying is knowing the perfect time to enter or exit a trade, that's not enough.
It's not even close to enough. That's the part everyone focuses on, but it's the trap. What truly determines your long-term success is your ability to execute your plan without sabotaging yourself because of those intense emotions.
Can you give me a concrete example of that sabotage? I feel like I have a million, but I want to hear yours.
Oh, the classic one is panic. Let's say the market suddenly drops. Just a sharp, scary dip. Your plan, which you made when you were calm, says, hold unless it closes below X. But you're not calm anymore. You're in a state of panic. So you ignore your plan, you close the position too soon, and you lock in a loss.
And then
And then, almost immediately, you watch it recover, and you're left on the sidelines having lost money for no reason other than fear.
I have done that. I have done that so many times. What about the other side of that coin?
The other side is just as dangerous. Euphoria. Let's say you rack up several consecutive wins. You're on a hot streak. You feel invincible, like you've solved the market.
I'm a genius.
I'm a genius. I can't lose. And what does that genius do? He lets euphoria take over. He abandons his risk management. He takes on excessive risk. Maybe he doubles or triples his position size. And consequently, one single bad trade wipes out all of the previous profits.
You're basically just narrating my trading journal from last month. It's this violent swing between panic and euphoria.
You've just described 90% of trading. As Admiral Markets notes in their guide on this, intense emotions just flat out negatively affect performance. It's not a question. Therefore, emotional discipline isn't just a nice-to-have skill. It is an indispensable pillar for any trader who aspires to be consistent.
Okay, you're convincing me, but let me push back a little bit. Why is this so essential for financial markets? I mean, a surgeon has a stressful job, a lawyer has a stressful job. Why are markets different?
That's a great question. The difference is the speed and nature of the feedback. Financial markets are characterized by their extreme volatility. We're not talking about a bad day. We're talking about minutes. Within minutes, a piece of unexpected news can send prices soaring or crashing. The feedback is instant, and it's tied directly to your money.
And our brains just aren't wired for that.
Not at all. Without the discipline of psychotrading, most investors react impulsively, and an impulsive reaction in a volatile market is almost always a poor decision. There was a clinical study involving day traders that is just fascinating. It found that the traders who reacted with greater emotional intensity to their gains or losses,
The ones who were really riding the roller coaster.
exactly, they achieved significantly worse results than the traders who were able to remain calm. The data was crystal clear. In fact, the research found a specific negative coefficient of minus 31.7% between unpleasant emotional states and performance.
Wow. So you can literally measure it. The worse you feel, the worse you trade.
That's it. And it's not just our internal state. It's social comparison. This is a huge factor now. A trader goes on Twitter or Reddit and sees other people bragging about making more money. This triggers envy. It triggers FOMO, fear of missing out. And what do?
They chase. They take on way too much risk to try and catch up.
You got it. In the United States, one analysis of this exact retail investor behavior found that this social chasing generated an additional volume of shares being traded daily.
600 million.
600 million shares. That's not strategic trading. That's just a massive collective emotional impulse. These figures all underscore this really uncomfortable truth. Without emotional control, even the absolute best designed strategy on Earth is doomed to fail. So psychotrading isn't a luxury. It's not an add-on. It is a fundamental necessity for surviving and thriving in the financial markets.
Okay, I'm 100% on board. This is the missing piece. So let's get into the weeds. Your work identifies 5 primary emotions that dominate traders. You've mentioned a few, but let's do a deep dive. What are they and how do we spot them?
Understanding these is absolutely the first step towards managing them. And the first one, the biggest one, is fear.
The obvious one.
Right. But fear is tricky. It doesn't just show up when you're losing. Fear emerges before you even open a trade in the form of doubt and inaction.
Talk about that. That's paralysis by analysis.
Precisely. A trader might see a perfect setup. Every single criterion in their trading plan is met, but they just can't bring themselves to click the mouse. Why? They're gripped by the fear of being wrong. And the result of that fear is a missed opportunity.
And missed opportunities are just as bad as losses, in a way.
They can be. And fear also shows up after a loss as a paralyzing blockage. You're so traumatized by the last loss that you're too scared to take the next trade, which of course is often the one that would have been a huge winner.
Okay, so that's fear. What's the flip side of that coin?
That would be greed. Greed is what pushes traders to take those excessive risks, and it almost always follows a streak of good results.
This is the "I'm a genius" feeling we talked about.
Exactly. This happens when someone just decides to increase the size of their positions without any solid, reasoned justification. Their plan says risk 1%, but they are feeling good, so they risk 10%. Moreover, greed is also what causes traders to overstay a profitable position.
Oh, this is a big one.
Huge. Your plan says take profit at plus $1,000. The trade hits plus $1,000. But greed whispers, what if it goes to 2,000? So you hold on, and then you watch in horror as it reverses all the way back down, and your winning trade turns into a loser. All because of greed.
That one hurts to even think about. What's number 3?
Number 3 is a little more subtle. It's hope.
Hope. I thought hope was a good